Welcome into the channel, folks. We're going to talk stocks in this video. We're going to talk the markets in this video. But right off the top, we got to talk some business. We got to talk about an email I woke up to here today. Here's what it said. By the way, thank you everybody that joins me. As always, thank you everybody. Subscribe to the channel. Appreciate y'all, okay? Upcoming changes to memberships in the iOS app. It was an email from Patreon. Now, Patreon's a very popular service that a lot of creators have, so their fans can support their content. Might even be charitable organizations and things like that use Patreon essentially, right? And it's ways to donate money to a person or an organization or something like that, right? It says, hey, Apple is requiring that Patreon use their in-app purchasing system and remove all other billing systems from the Patreon iOS app in November 2024. This means that starting in November, new memberships purchased in iOS app will be subject to Apple's 30% Apple Store fee. Ooh, first we want to be clear about one thing. This will not impact your existing memberships at all. Apple's App Store fee only applies to new memberships purchased in iOS app beginning in November 2024. So basically, if you subscribe to my Patreon or anybody else's Patreon, after November 2024, 30% of that money is going to go directly to Apple. You will have full control over how the Apple fee is applied. You can either maintain your earnings by setting a higher price for new memberships in the iOS app, or you can absorb the Apple Store fee. So basically, you're forced as a creator, you're either going to take a 30% hit to what you're making here, right? Or you're going to have to go up on all future memberships by at least 30% to kind of offset that, right? Which is not a comfortable situation. It's like either way, you're screwed. You either have to go up a bunch in your memberships to your Patreon tiers, or you have to take a 30% hit, right? Which means you're going to make 30% less money. 30% less money. You don't need to take any action continuing earning through the iOS app, but by default, if you don't do anything, your tiers will be displayed on the iOS app, will automatically increase to offset the Apple Store fee, right? There's, Patreon says they're working on every way to find, and I'm sure they have lawyers involved, but there's no way they're going to be able to win this. If Apple comes after you and says, we're taking our cut, they're going to come and take their cut. I saw Maverick posted this. I like this. The Apple Mafia wants 30% cut, or they'll cut your legs. You have no other choice. You have no other choice in this situation. So, for instance, I have my two main tiers on Patreon, right? The $7 one, which is just if you want to support my content. And then I have the $25 one where you get to see the stocks I'm buying and selling each week, be part of that Discord chat, those sorts of things. And then I even have the 5-figure award, right, that I send to people complimentary. So basically, you can apply for it if you're a Patreon member. And all you got to do is show proof that you have at least $10,000. I ship that to your house. That's like a physical product. I have to pay a company to make those awards. Then we have to ship it to my house, a pallet, right? Then ship those out to people's house. Like, that's a huge cost. Like, the cost of that is probably way more than just a monthly membership, right, of $25. So even that's something I'm looking at. Like, I might have to cut that for members that join after November, essentially, because it's just like, it's ridiculous. Here's the deal, okay? I'll break down the math like this, right? So we got Billy, he's 26-year-old. He invests $1,000 a month. He watches Jeremy daily, right? So Billy wants to see the stocks Jeremy's buying, be part of that Discord chat, see exactly how Jeremy runs a portfolio. So basically, if Billy joins after November 30th, his $25, right? Apple's going to take their $7.50. They get their money first, right? And then remember, I actually didn't even include Patreon fees in this as well. So Patreon gets their fees. So actually, my math is even worse in regards to what goes to the creator, because Patreon takes their fees. And then you got the credit card fees on top. Oh my gosh. Like, this is even way worse than I did my math here, okay? So basically, you're down to $17.50, right? Then the U.S. government's going to take at least $5.25 of that, which means I'd be left with $12. But after Patreon fees, after credit card fees, I might be left with $10 out of, if somebody wants to support with $25 there, right? Thank goodness I live in Nevada. Nevada doesn't take state income taxes. Just another reason why you want to live in a state with no state income tax. Because imagine I live in California, there goes another 10% to the state of California, right? What would he be left with if I lived in California after credit card fees, after Patreon fees, after Apple takes a hit, after the U.S. government? I might be left with $10. I'd probably be left with less than $10 out of $25, right? And that's anybody that joins after November 30th. Insane. Jennifer watches Jeremy twice a week, wants to show support, $7 a month. She's like, I don't care to see, what stocks he's buying, things like that. I just want to support, right? After all the fees and everything, I'd be lucky to get $3 from that, right? I mean, that's insane to think about that, right? It also shows definitely a level of desperation coming from Apple to get their revenue anyway. I mean, if they're going after a Patreon, like they're really getting desperate in this situation. That's incredible. Now, this is also will be the downfall of Apple in the end in regards to this. It's not just because they're going to piss off so many people that it's going to turn people off of buying Apple products over time, but additionally, the government's going to come after these guys big, because here's kind of the math and here's how this breaks down, right? So from the original $25 sale, now, since Apple's going to take their cut, the government might only get $5.25 roughly of that, of that sale, essentially, right? Previously, they would have gotten about $7.50. So we're talking about a major divergence here. Now, you might say, well, they're still going to tax Apple. Sure. But guess what? Apple is going to be taxed at much less of a rate than I'm taxed, which means in the end, the government ends up making less money in this situation, right? The U.S. government's getting less. Apple pays hardly any taxes as a percent compared to an average Joe or an average Jeremy. And so the U.S. government's not going to like this in the end, because they're going to be able to eventually they'll be able to prove this is like a monopoly type practice. You're just forcing this down people's throat. But ultimately, the government is really the only ones to get the shakedown. If you're a company and you're getting the shakedown before the government gets a shakedown, that's when we start talking about problems. And this is why this is going to be the downfall of Apple. Now, if you look in recent years, you know what Apple's tax rate is? It's around 15%. Look at it. Basically, since they, obviously T-Man did the big tax cuts for all the big corporations, right? That dropped Apple's tax rate and all these massive corporations' tax rates down. So now these guys are only getting 15%. And what does the average person see from this? What is the benefit? There is no benefit. There is no benefit. What does Apple do with all this extra money? They do share buybacks. They do dividends, right? It's not like Apple's like, oh, let's go hire a ton more employees. No, heck no, they don't do that. It's not like, I know plenty of people that work at Apple. It's not like magically they're getting an extra 10, 20, 30% raises this year. Oh, heck no. Oh, heck no. So Apple just ends up benefiting in the end from this. And what do? They still is not enough, right? We're going to go after Patreon in this situation. Now, if you look at the tax rates for an individual, we're taxed at, if you make good money, right, decent money, you're taxed 30% plus, 32% here, 35%, 37%, versus Apple's at 15%, right? So now we do have to take into account maybe Apple's lobbying efforts will pay off in the end, right? This is an article from 2023. Apple ramped up lobbying spending in 2022, outpacing tech peers. They raised their lobbying amount the most of anybody as a percent there. So we'll see how it all shakes out, but it's an ugly situation. It doesn't bode well for Apple that they're getting this desperate, that they're going after Patreon. I'm just telling you, it shows how much Apple's in trouble, and rather than try to innovate their way out of this, the Steve Jobs era, they would have innovated their way out of growth, right? They would have said, hey, we're going to come out with a new game-changing product, service, something like that will get us to grow much more substantially. Apple nowadays, they just don't have it like that, and so they got to do the shakedown, right? And so we'll see where it all shakes out at in the end, right? All I ask is, if you are somebody that's planning on joining my Patreon, please do so before November 30th. That's all I ask from you guys. And if you don't want to support through that, it's perfectly fine. But if you do want to support me through Patreon, I'll put that as a pinned comment today. Just please do it before November 30th, because after that, Apple's is going to take their fee in the end, and it's going to be 30% less to the creators. So it's just another thing that's going on out there, right? It is what it is. It's what we have to deal with, and there's honestly no way around it. So that is, right? But that's the situation. So anyways, guys, next up here, put to call ratio. So put to call ratio, this is the most important, or at least one of the most important things you can pay attention to in the stock market right now, in my personal opinion. And the put to call ratio is up again here today. Now, the reason this is so important is it shows you how many people are actively buying put options out there versus call options. And usually there should always be a lot more people buying call options and put options, because the market usually goes up, right? So here we are, we're still remaining pretty elevated on the put to call ratio. People are still looking for protection in regards to their portfolios. What happened last Monday really freaked a lot of people out. And it made a lot of people all of a sudden say, you know what, I got to hedge up my portfolio. I got to look for puts out there, right? And keep in mind, if you're over 0.8, you're in high ranges. If you go above 1, you're in kind of panic time. And so every once in a while, there'll be some sort of short-term panic. Like, for instance, Monday, we went to like 1.05 on the put-to-call ratio. It means more people were buying puts and calls. Those sorts of time periods, people are like in panic mode. But 0.8 is still pretty high here. And it reminds me similar. Do you guys remember during the beginning stages of Rona, there was a toilet paper shortage? Like, wasn't that something? Like, there's so much happened during that whole Rona time. Like, I feel like sometimes we just forget about all the crap that happened, right? No pun intended. But remember, there was a toilet paper shortage. And it's because all of a sudden Rona happened, everybody started freaking out, and they all ran to the store to get as much toilet paper as possible. And stores were trying to limit to 1 toilet paper per person. And I mean, it was incredible. Like, something you never thought would ever run out in a store was running out. Like, toilet paper shelves were completely empty. People were panicking, and just, it's human behavior, right? And the same exact thing happens in the stock market. All of a sudden people panic, and what do they look for? They start looking for protection. They start getting into puts, and usually you're too late in regards to that situation, right? It's like the person that, I mean, you got to be ahead of this stuff. You got to be ahead of this stuff. You want to look for hedges when no one's looking for hedges, because that's usually when you're going to get hit by something, right? Now, the interesting thing, you look at the Russell here. Russell struggled today. It was down almost 1%, right? Still struggling. Year to date, the Russell's up 2%. 2% for the year? Tom Lee, where's our 50% gain for the Russell stocks, man? Come on. Remember Tom Lee going in this year? He's talking about small caps, 40, 50, 60% rise. I'm looking for those babies, man. Come on. When's this Russell going to get rolling? We're ready to have some fun in this market, right? But the Russell's still struggling. Now, with that being said, just because a Russell's struggling doesn't mean there aren't opportunities or places to make money in small cap stocks. For instance, look at the Planet. Planet up another bunch today, right? Stock's up like 50% plus just in the past 5 trading days. I wouldn't be surprised if that stock's $1 plus after next quarter. And the reason being is the Planet is all of a sudden now growing their revenues again substantially. Their profitability is getting better. Their margins are getting better. So the whole story in regards to Planet is getting better and better and better for the first time in years. I mean, it's literally been years. It was just like years of the Planet. Everything was just getting worse. Revenue, margins, profitability, everything. And now we just started the inflection to the other side of things are going to start getting better. And that's honestly going to continue regardless of the economy, regardless of Apple taking their 30% cut in the end, right? You look at somebody like Honest. I mean, this stock's up 165% in the past year, despite the Russell not doing a dang thing, right? And so the Honest company, a very special opportunity there. They have their revenues going up more substantially than anybody anticipated. The margins have increased way faster than anybody anticipated. The profitability's gotten way better, way faster than anybody anticipated. So it's a freak situation in this market, even despite the weak consumer and all those sorts of things. The company's in massive turnaround mode, and they're executing on the highest level I've seen any company really execute a turnaround since ELF. Just to be quite frank, it's unbelievable, right? Look at a stock like Revolve, another small cap stock. This one's e-commerce play, clothing related. Stock's up 30% plus this year. 30% plus, despite the Russell being up, 2% this year? And so just keep in mind, even if the indexes aren't going up at a particular time, there's money to be made from the long side. There's money to be made from the long side, right? Because you're always going to have a certain amount of money coming out of stocks that are the losers, right? The bums of the stock market. Intel, right? Perfect example of a bum stock. Look at how much that stock sold off. People want to sell that stock. So then, where's money move? Well, it can move a lot of different places, but a lot of times it's going to move into positions that people feel much more confident about in the market, right? And that's just one example of a long list of stocks in the market. The only time really everything gets hammered from a long side is if you have a massive stock market crash. That's really, and that comes, every 5 to 10 years? In those very freak situations, once every 5 to 10 years, that's a one rare situation where you can't make money from the long side. It's just everything's getting hammered. Doesn't matter what you own. Growth stocks, value stocks, dividend stocks, it all goes down, right? But it very rarely happens. And so you got to always keep in mind in the stock market, most years, even if a specific index doesn't go up, there's money to be made. If the S&P 500 was only up 2% this year, there would be plenty of stocks in the S&P 500 doing absolutely tremendous. And you look at the Russell, up 2%, and there's plenty of small cap stocks that have performed 20%, 30%, 40%, 50% gains this year, right? And so that is some food for thought in regards to that. There's always money to be made in the market, regardless of what's going on, right? And specifically from the long side. Other than a crash, a full-blown crash, that's a little different, right? Speaking about crashes, On Friday's video, I spoke about ELF stock, right? I spoke about other stocks in that video and opportunities and things like that, right? But at the front of that video, I spoke extensively about ELF, the earnings, what I think is going to happen with the stock price, all those sorts of things, right? And that one is struggling right now in regards to stock price. This is a fun part of growth stock investing, right? 1,800% gain, like that's the fun part. This part recently in regards to ELF, this is a part that sucks. This is the issue with growth stocks, right? The stock down another 10% here today. That was after Friday. It was down, how much was it down Friday? 14 or 15% or something like that, right? So just the stock's getting absolutely hammered right now. ELF can't catch a break, right? In regards to stock price goes. And that's the big risk that you always have to account for when it comes to these growth stocks is, man, are they a lot of fun if they're just smashing numbers left and right. But as soon as, somebody doesn't like anything, and those ELF earnings were phenomenal. I went through it on Friday's video. If you want to watch that video and go in depth on everything, you can. But if there's just one little thing that's off, this growth rate over here, this margin over here, it's a reason to sell the stock off huge when you trade at very rich forward Ps, 2-year out forward Ps. That's why I speak about valuations all the time on the channel. Not enough people speak about valuations. They pay attention to valuations. It's so important. It's so important for the risk-reward profile. And it could be the difference between you making 1,800% on a stock versus losing 40% on a stock. Like a lot of it comes down to where you get in at, where you position at, right? This is so important, so important. Now, inflation is the next sort of subject, right? Because everybody's paying attention to what happens with inflation here. Where's the Fed moving? Let's be very crystal clear. Factually, inflation is dead. Factually, inflation is dead. And inflation is dead by looking at a few different things, and meaning the way prices are going up, it's done. So the reason being is you look at inflation over the past year. This is inflation. This is looking at commodities. Commodities up 0.1%. 0.1% in the past year, which means inflation is done. Like inflation is dead. That's incredible that commodities can't even go up in this situation. Remember, what is everything in the world made of? Commodities. And so if commodities aren't going up anymore at this point in time, right? Inflation is really done. And that's even despite us having some sort of major recession, right? Unemployment's still in the 4s right now. You got to keep in mind, if we were to have some sort of major recession where, let's say, unemployment rate went to 8%, 10% or something like that, don't be surprised if you see oil at $60 or $50 in that situation, right? Which would then actually cause the GSG here, which everybody should have on your watch list, GSG, that could potentially cause this to go negative, right? Never mind if you have gold and silver go down in that sort of situation, like this could literally go negative on a year-over-year basis, which means you not only would you not have inflation in the economy, you'd actually have deflation, which is a very rare phenomenon you ever have in the stock market. If we look at trueflation numbers, which I trust a lot more than the government numbers, I think trueflation numbers are way better than the government numbers. That's my personal opinion on that. Trueflation has a 1.5%, which is significantly below the Fed's 2% number that they want us at, right? Which means inflation is dead right now. Absolutely dead. So the moral of the story is the dragon has been slayed. The dragon's been slayed. In the dragon that was inflation, it's done. Its head's been chopped off. It's away. And it's away for years now. Like, the chances that dragon comes back alive in the next few years are very rare. Very low probabilities. The chances that dragon comes back, 5, 10, 20, 30 years from now, there's a pretty high probability of that long term, right? But for the short term, that dragon is done. Now at this point in time, the dragon has officially been slayed. There's no debate you can take to the other side to really say inflation hasn't been destroyed. It's been destroyed now at this point in time, which leads us to where does the Fed take interest rates from here? Now, right now we're at about 5.5% Fed funds rate, right? In an ideal situation over this next 12 months, so over this next year, so let's fast forward to August 2025, an ideal situation is the Fed goes from where they're at right now, about 5.5% Fed funds rate, to about 2.5% Fed funds rate over this next 12 months. That would mean we had an orderly economy. We kept unemployment under 5%. There was no shock and awe in regards to the banking system or anything like that. This would be very good. Very good. If we can have that, if we can a year from now be looking at a Fed funds rate 2.5, which would be probably slightly above CPI at that particular time, that's ideal, man. That is a perfect scenario. That means the Fed was able to orderly kind of lower rates, maybe 25 basis points at a time, 50 basis points at a time, something like that, right? Now, a disaster, a complete disaster, is a situation where we go from where we're at right now, 5.5, to let's imagine we're a year into the future, so it's August 2025, right? And the Fed funds rate's around 0 or under 1%. That would be a disaster. That means we had some sort of crash in the economy, probably a crash in the stock market as well. That means things got very ugly and the Fed had a panic. They had a panic cut. No different than they panic raised in 2023, right? From basically the middle of 2023 through the beginning of 2020, or excuse me, that was actually 2022. From the middle of 2022 through the beginning of 2023, right? The Fed had a panic raise rates. They were raising rates at 75 basis points at a time. They were panic raising, right? And so if we go into a situation where they panic cut, that means the economy got devastated, the market got devastated. That would not be an ideal situation. So this is, if you want to hope for something, hope for around a 2.5%. We can call it 2.5 to 3% Fed funds rate a year from now, because that means we had an orderly lower. Now, in terms of, probably not a lot of people look at the Fed balance sheet and what's going on there. Total assets of the Federal Reserve, it has dropped over $1 trillion. Over $1 trillion has been reduced over the past 12 months. We were, if we go back a year ago, we were at over $8.2 trillion of assets on the Federal Reserve's balance sheet. We're now under $7.2 trillion here. So that's phenomenal. My guess is we're going to probably end this year somewhere around $6.5 trillion to maybe $6.7 trillion in regards to assets on the Federal Reserve's balance sheet, assuming they don't freak out here at the end of the year and have to, start purchasing assets or something like that, right? Now, I do think there's a decent probability that the numbers could reverse and go back up in 2025, and that's if we get some sort of situation where we do have a big recession that eventually pops out, right? The Fed would start to say, oh, we got to reverse course here. We got to stop reducing the balance sheet and we got to actually start adding the balance sheet. So there's always a potential that's out there. There's no guarantee. I would call it like a 50-50 probability right now. But you could see something like this, right? You could see this balance sheet continue to shrink down to, around 6.5 trillion or so. And then all of a sudden we do a big U-turn and, right back up. Now, in regards to the next time the Fed's going to add to this balance sheet, I think we're going to 10 trillion plus. I really do. I think we're going to $10 trillion plus on the Fed balance sheet in the next go round. It's going to be a pretty substantial one. That's my personal opinion in regards to that. But I like that the Fed's been able to reduce their balance sheet in this situation. But we'll see how much longer it lasts. My guess is it lasts probably another, I would say at least 3 more months, but probably more to 6 to 9 months, and then they might have to flatten things out in reverse course and do a U-turn there. Okay. Now, do keep this in mind. I do think this is a good reference because the balance sheet for the Fed, the assets for the Fed was under $1 trillion before the great financial crisis. That's a little food for thought there. It's hard to even think under $1 trillion because now it's just so insane, right? But literally it's under $1 trillion. Obviously, we got hit by the great financial crisis, and that really changed the trajectory of the Fed's balance sheet forever, right? And now, anytime anything happens, the Fed is looked at as like, you guys got to come in, and you got to come save the day, right? And that's honestly the way it will always be from here on out, right? They really, in that situation, the Fed really got put into more of a controlling position than ever before. And it's kind of sad because now you listen to all these Wall Streeters, they're obsessed with the Fed all the time. All they can focus on is the Fed. And it's not nearly as much of a free markets anymore now at this point in time. It's not as much as about whose earnings or what. It's more about what the Fed's doing. And a lot of these Wall Streeters they'll let their buying and selling decisions be dictated by what the Fed's going to do or what they might do. And it's kind of sad, in my opinion, because it should be, what are the companies reporting? What are the companies doing for numbers, right? That should really take the highest level of importance. But nowadays, a lot of these Wall Streeters, and I understand it, like the Fed became so much more powerful after the GFC, and it's remained that to this day, and it's going to remain that. I don't think you can back out of that now at this point in time. Once you go down that rabbit hole, it's there forever, right? No, the other interesting thing, we come back to the Russell 2000. This is a 3-year chart of the Russell 2000, and the Russell's down 8% in the past 3 years. I looked at, August. We went back to August of 2021 versus now, and it's very fascinating to see the Russell down 8% in that amount of time. And it makes you think, are we at the beginning or the end of a cycle? And it's confusing because usually it's clear when it comes to Russell 2000 specifically. If you're at the end of a cycle, the Russell's usually booming. If you're at the beginning of a new cycle, the Russell's booming. And so to see the Russell where it's at in kind of no man's land over the past 3 years is very confusing to where are we at in the cycle? Are we potentially mid-cycle right now? We're not actually at the end of a cycle like some people think, and we're not actually at the beginning of a cycle like some people think. What if we are mid-cycle, right? Because you look here, I backed this one up here. This was the end of the cycle before the great financial crisis. This was kind of, a 3-year span roughly here of looking back at kind of 04, 05, 06 into 07. And look at the Russell during that time. It performed tremendous. So it was performing tremendous going into the great financial crisis, which kind of made sense that, you were, getting toward the end of the cycle. The end of the cycle, the small cap stocks roll, right? And then guess what happens? Obviously, we have the crash. All the indexes fall 50% plus, right? And then a new cycle starts. The Fed bottoms out everything. Unemployment rate starts to kind of bottom out the end of 09 into 2010. And a new cycle forms, and the Russell goes up and up and up. And over that next few years, the Russell over doubles in that amount of time. And so it's clear like, a new cycle had started. The Russell had led us to that new cycle, right? Now, you could, if you're kind of grasping for straws here, you could make an argument that we are in a new cycle and that the new cycle started in November. It's an argument that could be made because you come off those November lows, and since that time, the Russell is up 25% since, basically November 2023. I don't think it's a strong argument that could be made yet, but it is an argument that can be made. But the other weird thing here is, could we really start a new cycle in the Russell with interest rates being relatively very high, right? If you look at the past 20, 30 years for Fed funds rate, we're very elevated ranges based upon the past 20, 25 years, right? So it would be weird to start a new cycle with the Russell while the Fed funds rate's 5% plus, right? Be very strange. But you could make an argument. We'll see. Maybe we'll look back and we'll be like, that was the start of the new cycle at the end of 2023. I don't know. We'll see here. But it's also weird because you go back to 2022, right? And the NASDAQ bottomed first, which is also very weird because would tech stocks really lead us out, coming out of a cycle, or to start a new cycle, right? Rather than the Russell. That's another thing that's kind of strange there. Now you look at 10-year charts here, it's also very strange because the Russell significantly underperformed the S&P 500 and the NASDAQ over the past 10 years. Look at the 10-year returns for the NASDAQ, almost 400%. S&P 500 is 175+%, and the Russell's 82%. That's horrible performance for the Russell. Small cap stocks have done absolutely tragically bad in the past 10 years. Now, the Russell should almost always be beat by the NASDAQ over a 10-year span. And the reason being is we've obviously gone through kind of a tech revolution over the past 30 years. So naturally, tech stocks should do better, so the NASDAQ should do better, right? But the fact that the Russell's getting destroyed, it's getting doubled up by the S&P 500. That's strange. If we look at the previous 10 years, 2004 through 2014, right, it kind of backed up to summer 04 through summer 14 here. Look at the NASDAQ 200% gain, Russell 111%, S&P 500 87%. So the Russell actually beat the S&P 500 over that time, but it wasn't like there was a huge divergence between those two, right? If we back it up another 10 years, 1994 through 2004, right? Check this out. Look at this. S&P 500 up 159% during that time. The Russell up 158%. So the S&P 500 and the Russell right together in that situation. Obviously still getting outperformed by the NASDAQ, and that's natural, right? And by the way, if you're wondering what the heck happened here, that was a tech bubble. That's when the NASDAQ went to the moon and then crashed back down, okay? That was an incredible situation, obviously, freak event that happened there, but it was something that happened. And so the Russell performing the way it's performing, very strange, man. Very, very strange. And this is why you can't really say I don't think you can say with any sort of big level of confidence we're at the end of a cycle or the beginning of a cycle, because the Russell's not yet giving us enough clues on being at the beginning or the end of a cycle. If the Russell does come back to life over the next 6 to 12 months, I think you're going to be able to actually make a much stronger argument that we're at the beginning of a new cycle rather than the end of a new cycle, which is weird because If the Fed's usually lowering rates, it usually means you're at the end of a cycle, right? You're going into a bad economy, you're going to go into a bad recession, those sorts of things. So it'd be very strange to see the Russell ramp up over the next 6 to 12 months into a Fed cutting cycle, right? That would be strange. It's not all around the possibility, though. We've seen so many strange things happen over the last many years that weren't things that traditionally happen. Maybe also part of it is how heavy-handed the Fed is in regards to the whole situation, right? The Fed used to not be, the market used to not be this dependent upon what the Federal Reserve is doing. And obviously in recent years, it's changed. It's changed in a massive way. So could something like that happen? There's a potential. And if the Russell does roll heavy over this next 6 to 12 months, that will mean we actually did start a new cycle in 2023, which is interesting, right? Because that will shock a lot of people that we could have started a new cycle, because a lot of people just aren't there right now. Tesla's held up very well since January 2023, right? That stock bottomed around $101. You know, recently it's been around $200. I think with interest rates being as high as they've been, with how weak a lot of international demand's been, car sales in general, auto sales in general, I think Tesla stock has held up tremendously well, in my personal opinion, really over this past year and a half or so. Now, there's some big news in regards to Tesla here today. Let's say out of Tesla already here. Tesla sets a new date for the release of Cybertruck range extender. Tesla has pushed back the release of the upcoming Cybertruck range extender. So this is essentially an extra battery pack that's going to go in the bed of the truck so you can get more range. I'm personally not buying a Cybertruck until I can get this. This is specifically what I want when I get a Cybertruck. I will be buying a Cybertruck, but not until they have the range extender. So they put on their website now, production plan to begin early 2025. Okay. Now the range extender is going to be an estimated extra $16,000, which I don't mind paying. I've done very well in Tesla stock, obviously, over the years, so I don't mind paying that. Bringing the range to about 470 miles. Now, here's the deal. You're not going to get 470 miles of range, okay, unless you drive perfect on a perfectly flat surface and everything's perfect, okay? No different than, some auto manufacturer says you're going to get 33 miles a gallon on your gas, and you don't actually get 33. You might get 29 or 28 or something like that, right? Unless you drive it in perfect conditions and you never hit the pedal too hard and all these sorts of things. So, and you don't have the AC running, all that stuff, right? So if they say 470, the reality is could probably get 330 to 340 miles of true range, in my personal opinion, which is, once again, you're going up hills. You got a bunch of different environments you're driving in. You're not driving it perfect. You might be driving faster than you're supposed to be driving under perfect conditions. So you probably get around, like I said, 330 to maybe 350. Now that's perfect, because if I can drive somewhere and it's less than 5 hours, I'll drive there. So a lot of the places I'll drive, pretty much every single year, if not multiple times during the course of a year, is out to Phoenix, Arizona, right? And that's a 4-hour and some change ride. And that's about 300 miles. So I could go from Vegas to Phoenix in this vehicle without having a supercharge, which would be phenomenal. I would love that. And then worry about supercharging once you're actually in the city, right? That would be great, because right now you can't do that. In the Model S gets 300 something miles of range, but the true range is like more in the 200s, right? Same thing with my Model X, supposed to be 300 something miles of range. The true range is 200 something. You always have to supercharge halfway through the ride, right? Or somewhere roughly in there. And so this would be phenomenal. That's why I'm looking to get it. If you go to somewhere like Newport Beach or Orange County area, that's about 278 miles, so I could go there and not have to worry about charging till I get there, right? Same thing, like I pretty much every year at some point we'll go to Zion National Park, 150 miles from Vegas, so could drive there and back and not have to worry about charging. Like that's why I'm looking to get that vehicle, so I'm looking very forward to that. But Tesla's obviously got to get on it, right? Now, a couple stocks I'm paying attention to here. Estee Lauder. This is a stock I just started positioning here in the past week or two. I want to buy this stock aggressively for the next 2 to 5 months. And this one just continues to set new 5-year low after new 5-year low. It seems like it never runs out of sellers. Stock now down 53% in the past 5 years. Absolutely historic run for Estee Lauder in terms of how bad the stock's performed. But I need to buy a lot of shares over this next 2 to 5 months here in this one. Celsius, I was also keeping an eye on Celsius today. And the reason being is finally Celsius was green during the trading day. And I was like, whoa, Celsius finally going up, right? And it finished red, which is very just kind of disheartening thing for people that may be holders of that stock. For people like myself that are looking to likely start a position soon here in Celsius, I mean, it's an ideal situation for us, right? But for the ones that are holding that stock, no bueno. But yeah, 3 months now down 54%. That stock is just absolutely trashed. And the thing you got to worry about in regards to Celsius and an Estee Lauder and a lot of these stocks that have gotten destroyed, okay, is remember what happens in the fourth quarter. What happens in the fourth quarter with a lot of these stocks is what we call tax loss harvesting. And so if people made good money on some other stocks out there this year that they sold for profits, I don't know, Meta and Nvidia and some of these sorts of stocks, they start to look at their portfolio and say, okay, what's lost money so I can offset my tax gains, right? And so sometimes they look and they're like, oh, we're down huge in our fund on Celsius. Sell Celsius into the end of the year, take the tax loss hit. If we want to buy it back at the beginning of 25, we'll buy it back in the first quarter, second quarter of 25, right? If not, we won't buy it back, right? And Estee Lauder, any of these stocks that have been really destroyed, you can see tax loss harvesting in that fourth quarter. And that's why a lot of times you see many of these stocks bottom in the fourth quarter of the year. That's why it happens all the time, because people do that tax loss harvesting in the fourth quarter. And so naturally, they get one last big flush when you get the tax loss harvesting hit there. And then from there, things start to look better, right? And then you kind of run out of sellers by the end of a year, and then you go into the next year and you kind of start attracting more and more buying pressure to the stock, especially if your fundamentals get better, which I think for Celsius, I think for Estee Lauder, I think for stocks like Nike and a lot of those, the fundamentals will get better as 2025 rolls along, which will bode well for those companies. And then when you have the fundamentals of companies starting getting better rather than worse, compound it with everybody that wanted to sell sold and more buying pressure come in, that's a very positive thing. But for these stocks in the short term, it's still an ugly setup, man. And you got to keep in mind what happens if the S&P 500 gets hit 5, 10, 15%. I'm telling you, these stocks are going to get hit harder. So if let's just say the S&P 500 went down 8% over the next 30 trading days. Celsius is going down to 35. Estee Lauder is probably going under 80 in that situation, right? It'd get ugly. And then you got tax loss harvesting in the fourth quarter. You could push down even lower. Could you see Celsius go under 30 to the 20s? It maybe. But you need an S&P 500 sell-off there, and you'd probably need also tax loss harvesting to come in. But man, it's rough, right? And so these sorts of stocks are opportunities in the market, but man, it's no bueno right now for them, right? Now, a few earnings I'm looking at this week. I'm going to be interested to see what their numbers are on Tuesday. Home Depot, really interested to see what their numbers are on Tuesday. Their numbers have not been the best recently in the past few quarters. Walmart, always listen to what Walmart has to say about the consumer, right? And then what Wall Street, the stock Wall Street really cares about the most this week, in my personal opinion, is AMAT, Applied Materials. They're all going to be talking about that one and paying attention to what's going on there, okay? All right, guys, appreciate you joining me as always. Thank you so much for being here. Thank you for being subscribed to the channel. If you support my content on Patreon, I appreciate y'all. If you want to support me on Patreon, please do so before November 30th. I'll put that as a pinned comment today before Apple starts getting their 30% fee. All right, guys, much love as always, and have a great day.